The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Before we start, let me go over a few housekeeping matters. First, all attendees on this webinar are going to be muted. Secondly, the presentation is going to be recorded, so you'll be able to watch it afterwards. And third, we'll have time toward the end of the hour to take questions from the audience via the chat function. So good afternoon. My name is Peter Herson. I'm the president and CEO of the Greater New England Minority Supplier Development Council. Our network, which includes our council, 22 other regional councils, and the National Minority Supplier Development Council, are focused on economic inclusion and minority business development. Minority-owned businesses are critically important. They generate economic output, they create and maintain jobs, they generate incremental tax revenue, and their leaders are servant leaders in the communities in which those businesses operate. Despite this, the PPP loan program literally flew right over the minority business community. But that's a subject for another day. More generally, minority-owned businesses find it difficult to obtain all types of capital, but it's especially difficult for them to obtain equity and mezzanine capital from private equity funds, and that dearth of capital is stunning their growth. Today is the second installment of our Capital Access series, and we will have a conversation with the leaders of three of our country's most prominent private equity funds. Private equity funds like those led by our speakers today can support minority business development in a number of ways. First, they provide patient growth capital for firms pursuing organic growth. Second, they can provide capital for minority-owned businesses that seek to pursue inorganic growth strategies like mergers, acquisitions, and joint ventures. And third, they can provide capital to create minority-owned businesses in connection with divestitures and spinoffs from our corporate members, and in connection with change of control transactions involving the non-diverse suppliers of our corporate partners. We're fortunate today to have as panelists three executives from private equity funds that are led by people of color, and they all have a documented track record of success. We have William C. Kennard, who's the co-founder of Ashford Capital Management. We have Lawrence C. Morris, PhD. We call him Larry because we're all friends. He's the co-founder and managing partner of Fairview Capital Partners. And we have Lloyd G. Trotter, the founder and managing partner of GenX 360. Let me just tell you a little bit about each one of our panelists. Bill Kennard is the co-founder of Ashford Capital Management, a firm that is incredibly successful. And parenthetically, G&E and SDC just certified as an MBE a company that was recently acquired by Astra, Communication Technology Services, which is headquartered in Marlborough, Massachusetts. Bill serves on the firm's investment committee. He's the former U.S. ambassador to the European Union, serving from 2009 to 2003. Prior to that, he was managing director and global partner in the Global Telecommunications and Media Group at the Carlyle Group. Prior to Carlyle, Bill was U.S. Federal Communications Commission General Counsel from 1993 to 1997 and the chairman from 1997 to 2001. Bill's received awards from the Congressional Black Caucus Foundation, the Hispanic Chamber of Commerce, and he's received honorary degrees from Howard University, Gallaudet University, and Long Island University. He's currently on the board of directors of AT&T, Ford Motor Company, Yale University, Metropolitan Life Insurance, and Duke Energy. He graduated from Stanford University and received his JD from Yale Law School. Larry is the co-founder and a managing partner at Fairview, a firm that has managed more than $10 billion since its inception. Fairview helps investors proficiently access the best new firms, small firms, and diverse managers across the private equity spectrum. Prior to co-founding Fairview, Larry held positions with TSG Ventures, Equico Capital Corporation, and UNC Ventures. He serves on a number of advisory boards, including the U.S. Venture Partners, Battery Ventures, Sierra Ventures, and Trinity Ventures. He is a member of the board of directors of Webster Financial Corporation in Connecticut and the Institute of International Education. He is also chairman of the board of trustees of Howard University and Harris Associates Investment Trust. He's a former board member of the Princeton University Investment Company and a former member of the board of trustees of Princeton University. Larry graduated summa cum laude in Phi Beta Kappa from Howard University, having spent his junior year at the London School of Economics and Political Science. He earned MA and PhDs from Princeton University and has been a postdoctoral fellow at Harvard University. And he's also an author. Larry, several years ago, authored a book called Sundial, which is a fascinating novel that takes place on the campus of Howard University, where he is an alumnus. And as I mentioned, he's now serving as the chair of the board. So if you get a chance, check out Sundial. I read it several years ago and really enjoyed it. And next, I want to introduce my good friend, Lord Treiler. Lord is the founder and managing partner of GenX360 Capital Partners. You know, Lord launched the firm after nearly 40 years with General Electric. During his GE career, Lord was named Vice Chairman of General Electric, and he was the president and CEO of GE Industrial, where he was responsible for a $28 billion business with nearly 80,000 employees worldwide. Prior to this role, Lord was Executive Vice President of Operations, where he led efforts to improve operational excellence across GE's businesses. From 2004 to 2006, Lord served as President and CEO of GE Consumer and Industrial, a role he assumed following the 2004 merger of GE's consumer products, industrial systems, and supply businesses. Lord began his GE career in 1970 as a field service engineer. He went on to hold production and technology positions in several GE businesses, including lighting, gas, turbine, and appliances. He was later elected Vice President and General Manager of Manufacturing for Electrical Distribution and Control. In that role, he was responsible for the entire manufacturing process and for the integration of 40 production facilities throughout the world. 2 years later, Lord became the business's president and chief executive officer. And in 1988, when it merged with GE Industrial Control Systems, he was named a GE Senior Vice President and the President and Chief Executive Officer of the newly created Industrial Systems. Lord is a founding member of GE's African American Forum. He represented GE for America's Promise, an organization aimed to increase volunteerism in support of youth. He has received numerous GE awards, including the 2001 Lifetime Achievement Award and the GE Chairman's Award in 2003, 2004, and 2005. And he also received the Best Operations Performance of the Year from GE Chairman and CEO Jeffrey Immelt. Lord graduated from Cleveland State University with a bachelor's degree in business and administration. And in 2001, the school awarded him an honorary doctorate degree. Lord has also been awarded an honorary doctorate degree from the School of Business at North Carolina A&T. In 2005, Black Enterprise magazine named Lord one of the 75 most powerful African Americans in corporate America. Ladies and gentlemen, please join me in welcoming Bill, Larry, and Lord today. So we're going to have a conversation. These gentlemen all know each other, and we all know each other, and we decided rather than just have a sort of one-dimensional approach to this, we're going to have a conversation. We're going to talk about two distinct issues. One is some of the challenges in folks of color becoming fund managers and obtaining access to capital so that they can manage private equity funds. And secondly, we're going to spend some time having them talk about how they make investment decisions, what are some of the particular things they look for when they're making a decision. And then once they've made that investment decision and made the acquisition or provided the growth capital, what do they provide to their portfolio company in addition to capital? So let's just jump right in. Larry, you and Fairview have made an incredible dent in the issue of providing access to capital for fund managers who are diverse. Can you share with us, some of the challenges and opportunities you see, and whether or not you've seen any issues in terms of the performance of the funds that you have invested in?
Well, first, Peter, I'd be remiss if I didn't thank you for the opportunity to be here. It's a great pleasure. And of course, it's always a good thing when I can be in the company of gentlemen like Lloyd Trotter and Bill Kennard. So I'm appreciative of being here. My partners and I at Fairview have been at this now since 1994. So we'll celebrate our 26th anniversary this September. And we entered the marketplace in raising our first fund back in 1994 with the thesis that there existed a cadre of experienced investors who had demonstrated their ability over a significant period of time investing institutional capital profitably with minority entrepreneurs, diverse entrepreneurs, yet they'd had difficulty accessing the broader capital markets. So our thesis was if we could raise a substantial pool of capital to sort of bridge the gap between the institutional investor community and this group of talented investors, we could expand, the opportunities for diverse managers across the country. And so that thesis has sort of played itself out. Now, you mentioned in your introduction that we managed upwards of $10 billion now cumulatively in funds over that period of time. And so it would seem on the surface, well, clearly we've had some success because you don't get to go back to the well if you're not doing the things that you're supposed to do with the capital. But having said that, I have to say that even in 2020, challenges remain, quite frankly, in raising capital focused on this space. So while one could perhaps make the case that it has become somewhat easier, it's far from being easy. When we were kind of all in school, I think we were taught and we believed when we entered this business that all one needed to do was perform. And if you performed well, the capital would flow because capital seeks the highest returns in the marketplace. That's the way the capitalist system is supposed to work. And we have found that sometimes even in the face of superior performance, it's not guaranteed that capital will flow. Having said that, if we look broadly both at our portfolio's performances as well as information we have now based on studies performed by the Knight Foundation as well as the NAIC, I think there's ample data now that shows that diverse managers perform exceptionally well in the private markets. In our particular case at Fairview, kind of the experiment, if you want to call it that, is closer to home. We've been investing in so-called mainstream, difficult to access venture capital funds since 1999. These are funds that, generally have Roman numerals of, 10 to 20, if you will. So they've been in the business 20, 25, 30 years. We know them intimately. We've performed very, very well with them. And we've invested capital, large sums of capital on behalf of institutional investors in that space. But what that gives us is a lens into the performance, if you will, and the behaviors of some of the best venture capitalists in the country. At the same time, we have built portfolios that are anywhere from 60 to 100% comprised of managers who would be considered diverse by any indicia. And we've been able to generate comparable returns. So for us, it's a no-brainer. We can look at the returns of some of the best, broadly considered known and well-known best venture capitalists in the country, and we can look at the performances of our portfolios of diverse managers, be they in venture capital, growth equity, or buyout. And we've generated comparable performance for our institutional investors. So there's just not a question in our minds about what can be accomplished when you invest with talented people. And by the way, we're using the same lens. And we're not making distinctions, if you will, when people come into the door with respect to the lens through which we process investment opportunities. The criteria are the same. The bar is the same. And quite frankly, and you know, the good news is we've been able to generate comparable returns. So the returns are the same.
So thank you, Larry. So Bill and Lloyd, from the same perspective, you've had to raise funds, and we all know how difficult that is. Can you share with us some of the challenges you faced? And the reason this is important is that unlike a bank making a credit decision, you folks are really looking at investing in entrepreneurs and not just trying to get your money back, but to generate a return that's commensurate with the risk you're taking. So you really are making a big bet on the jockey, not just on the horse. So one of the theses I have is that if we're going to get more private equity capital to minority-owned businesses, we have to have folks that look like those entrepreneurs. Not to say that you will make a different investment decision, but you will at least not let any explicit or implicit biases get in the way of you putting that capital to work. So to the point of what's involved in trying to raise funds, and Lloyd, you and Bill have both done it more than once. Can you just touch base a few minutes on some of those challenges?
Well, typically I'll start. We've been in business since 2007, and it starts with making sure that you have access to a Rolodex of where to go and get those funds. In our case, the first meeting we held was with Larry, and it was just to do a test run, not necessarily for investment purposes, but we knew Larry and Fairview Capital had been in the game for a long while. We put together our value proposition, and we wanted to try it out with Larry and Joe and Price. In that meeting, we got really some very good feedback on a few things. Where we're hitting the real important points. Two, the length of time you have in order to get their attention in a meeting, and then keep their and hold their attention in a meeting, and then again, some of the areas that we should look to go and raise those funds. We also encountered a little bit of a problem because our goal in our first fund was roughly $500 million, and we had been targeting that, in that our experience level sort of warranted it, we thought. But what we also found was, as a minority firm, there are what I call minority set-asides with some of the big companies that do place money into equity funds, and we quickly got the "you're too big for our minority set-aside." So it was how do we get to the big boys door, and how do we get access to make our pitches known to individuals in large corporations and so on. So knocking on the doors, we got the doors open, got a lot of help from a lot of people. Our first fund target was $500 million. We actually exceeded that target and raised $600 million, mostly from pension funds, state pension funds, and then large Fortune 50 companies, where I had a lot of contact with a lot of people in those companies, like a Boeing, UPS, Verizon, and so on. But it was a lot of meetings, and it's the less enjoyable portion of being in private equity, in my mind. I enjoy operating companies It's a high-level art of begging, actually.
True that is.
Well, Peter, thanks for pulling us together. It's really great and really an honor to share a panel with Larry and Lloyd. You're guys who were really pioneers in this business and who I followed long before I knew them. I was following their what they were doing in Larry's case in with Fairview. So it's just an honor to be here. Thank you. We're sort of in a different stage in our development. We're a first-time fund. We're only, I guess, coming on 6 years old now, and we have. So we're very much new to the business of raising capital for our own fund. My partners and I have experience in private equity. Really, the nucleus of our fund is a guy named Mark Johnson, who I met at the Carlyle Group. I actually hired him from Blackstone, and I left Carlyle to join the Obama administration. He left to form Astra, our firm, and then we reconnected and became partners and co-founders with 3 of our other co-founders. I would make a couple of observations about raising money, particularly as a first-time fund, a minority fund in this environment. One is that there are a number of so-called emerging manager programs where I think, as Lloyd was touching on, these are sort of set-asides for diverse managers. It can be a bit of a trap for private equity funds, minority managers, because you sort of get tracked. And as Lloyd touched on, there are not big dollars there. And also, there's no guarantee that if you get some money from an emerging market program, that they're going to continue to support you as you grow. And so we took a little bit of a different path. We took, I would say, a more mainstream path, and were able to successfully raise money without, going through those emerging manager programs. But it is difficult, as Lloyd says. You have to a lot of doors get slammed in your face before people start writing you checks. I have found that in our experience, and also watching other first-time funds in the marketplace today, many investors, many LPs, are not really willing to take a risk on you unless you can demonstrate that you as a team have actually done deals together. And so in our case, before we raised a fund of committed capital, we went out in the marketplace and were able to get co-investors to do our first deal. And so investors really wanted to see that we could gel as a team, we could successfully close a deal and manage a deal before they were really willing to commit capital to our fund. And I've seen that replicated with a number of first-time managers. The good news is that there is a lot of money on the sidelines for, what's so-called fundless sponsors, where co-investors will back you in doing a deal before you have a fund. And in our case, that was really critical. So the major investor in our first deal was then converted into an LP when we actually decided to raise our fund.
So thank you. So as I see it in the network that I'm a part of, we have across the country 11 to 12,000 minority-owned businesses certified. And beyond that, we probably have across the network over 1,400 corporate members with our council and the other councils. And so the combination, I think, presents a lot of opportunities for deals, because as I mentioned when we were starting, for our corporate members, they're always divesting divisions and subsidiaries. They always have, non-diverse members in their supply chain where there's an opportunity, because the children don't want to take over the business, for someone to step in. So if we could segue now in terms of, when you're looking at potential investment opportunities, because I hope that there are a lot of folks that are not only on the line, but that will listen to this once we're done, they'll think about Astra, they'll think about GenX 360 when they want to do an acquisition, or when some corporation wants to create a large MBE overnight. Tell us a little bit about your process in terms of looking at investments and how you go about making that positive investment decision.
Well, I'll jump in. We have an investment process where we invest in the communications, telecom, tech-enabled services space. So, we're fairly specialized in that regard. So we're not looking at every type of business in the marketplace. We really are quite focused. All of our partners have spent literally their lifetimes in technology and telecom as investors, as operators, as technologists. And so what we look to do is watch trends in the technology space. And it's a really exciting time right now to invest in technology, because in my career, now over 35 years in and around telecoms, I've seen so many trends, technology trends, that created huge wealth creation opportunities. And, we've all seen this. It started with cable television, and then wireless and the internet sort of commercialized around the same time. That beget broadband networks to move more data traffic, and generations of wireless phones, beginning with 2G, and now we're on the verge of the 5G world. So there are, wonderful investment opportunities, and now we're moving into what I call the hyper-connected world, where devices that were not previously connected to networks are now being digitized. Your refrigerator, your toaster, your running shoes, your car, your smartphones, everything is part of a network. And those networks are becoming both more ubiquitous, but also more complex. And so for people like us who understand how these networks work and where to find value in them, they're great opportunities. So we have identified a number of areas of promising investment, and we dive deep and surface opportunities that way.
Great. In our case, we are looking at a different lens, of opportunities. One, if you look at my background and then the background of some of the more senior people in our organization, we grew up in manufacturing businesses. So we define our fund as being looking at industrial B2B manufacturing and services companies. That's where people believe we have the skill set to operate and run. And we stick to that knitting. We get requests for things that we really don't bring any real value for. So, and our investors, I think, would get a little bit worried if we started running off trying to make movies or whatever. So when I look at it, B2B to us is, business services or businesses that manufacture things. Typically, they're headquartered in the US. We have done a couple of international deals as well, but they're making parts. Typically, what we look for are fragmented industries where not only can we do a platform deal, but we can do bolt-ons. So we look at organic and inorganic growth. So if I take a look at a tooling company that we purchased, the company was roughly 50 million in revenue, and we, over the course of an 18-month period of time, did 5 additional acquisitions to roll it up to $220 million of revenue. We started with a company that was roughly $8 billion of EBITDA, and today is $35 million and trending before COVID up to 40 million, which was their base plan for this year. They'll get close to that, by the way. So it really is, when investors look at you, it's almost like, what do you really have a PhD in? You know, and in my case, you know, operating in GE for 38 years, becoming the vice chairman of a $38 billion corporation, doing deals while they were, you know, done inside of a large corporation. But it was all manufacturing. It was all manufacturing while, you know, also being on the GE Capital board. So I understand the capital financing portions of it as well. But it has been defined for us, B2B. And then there are certain segments I don't ever want to touch, like consumer. I ran our consumer business in GE. And it's really just a tough business, low margins. And it's not the kind of thing that I think we want to do. But we look at things in the ag space, things in the aero space, things that, you know, really are pretty sophisticated manufacturing initiatives that, you know, companies are willing to pay premiums for, you know, and they're willing to really trust you with making sure that they never get shut down as a result of it. So again, you know, unlike Bill's, where he's in a segment that they telecom and so on, where they really understand it. And if you look at the portfolio of his team, people get it. If you look at the portfolio of our teams, you know, their resumes, they would say, yeah, these guys really understand sophisticated manufacturing.
So looking through the lens of, there are a lot of different ways for private equity funds to achieve incredible returns. You can load up a company with debt, fire a bunch of people, and back into good returns that way. But a better approach is to really build the company and make it better. So I'm going to say something that might sound crazy to all of the MBEs on the call, but as I see it, when you look at, you know, Larry in your role as a fund of funds, and Lloyd and Bill in your roles as private equity funds, you actually bring more to the table than just money. So could you just take a few minutes and share with the folks on the line what that means? And just as a sort of segue, I've heard Lloyd, when he was at GE, talk about how he could pull into a parking lot of a company and tell you a whole lot about what was going on in operation before he even walked in the door. And I was just fascinated when he shared that with me. But again, you know, just to the direct question, you know, what do you three gentlemen in your organizations bring to the table in addition to money?
Well, you know, typically we're buying smaller companies, and I say these smaller companies, their operating rhythm and rigor isn't there. You know, it's not a process that's repeatable. You know, so what we try to do is teach them how to take their operations to a whole nother level. You know, to me, managing cash, managing productivity, which gets you higher margin rates, and making sure that you're treating your customers very, very well is, you know, what we bring to the party. And it's really a hands-on kind of sport. You know, one thing about our company is we don't do deals where we don't have control. You know, so I just won't do a deal where I don't have more votes than everybody else sitting around the table. You know, and therefore, I think I've got your attention on why you're going to listen and why you're going to show those improvements. So it is that. You mentioned leverage, Peter. You know, I'm a firm believer in not over-levering companies, particularly in my space, because I don't care what you think about cycles. Every business will go through a cycle, and you have to be able to ride out that cycle, whether it's now the virus cycle. You know, we have 14 portfolio companies, and the first step in managing those 14 companies was getting them all deemed essential, so they never shut down. You know, so we operated through the virus cycle, every one of our portfolio companies. Now, saying that, the tactics changed on how we did it, as opposed to monthly operating reviews with some special projects that we would work with them on. It was a weekly cadence on two things that was very, very important. One is, where's your cash burn look like? And then where are your costs vis-a-vis the top line that you are seeing, and no guessing around where you think you're going, because we've never been there before. And those meetings led to real specific actions on, you're at phase one, which says your costs ought to be at this level. You're burning cash too fast and you need to do these three things. So a really tutorial on tactics as we went through this cycle, as we're going through this cycle, because it's not over. And what we found is from March to now, we categorized our businesses into 5 categories. Some where, the worst category, they lose more than 50% of their top line. And the better categories, we have some businesses that literally grew during this period. And each of them had another set of problems. The businesses that grew, their problem was finding people in order to build the product. Finding and making sure we ramped up procedures and methods so that we didn't bring the virus into those plants. So it really was just hands-on, real coaching on what you were going to do to be a good business in this particular environment.
Yeah, I would add that in addition to all the things that Lloyd just mentioned, sort of professionalizing smaller companies, getting them to be more focused on financial oversight, reporting and metrics and whatnot, having partners who have operational expertise is really, really important when you're dealing with smaller growth companies. So 2 of my partners have spent most of their careers as operators of telecom businesses. We had one company, actually our first portfolio company, we lost our CEO. We had to send one of our partners in to run the company for a period of time. And so, having that sort of in-house expertise is important. The other thing I would add that I think is really an important skill set that we can offer portfolio companies is to give them our network of relationships. And this is really important when they need to source talent, when they're looking to do acquisitions and they want to source opportunities. We have sort of a lifetime built up of banking relationships throughout the industry. And so often smaller companies just don't have those networks, and making those available to smaller companies is really making and add a lot of value as an investor.
I would only add as a footnote, Peter, in our parlance, what you've heard from both Lloyd and Bill comes under the category of company building expertise. I mean, when we're vetting teams of private equity professionals, we're looking at their toolbox, if you will. What experience do they have in working with companies, filling key leadership positions, board recruitment, business model refinement, formulation of optimal product sales and go-to-market strategies, development and execution of appropriate financing and syndication strategies, new customer introduction, acquisition, supply chain management, identification of appropriate M&A candidates. All of those things are things that entrepreneurs, as they are thinking about partnering with private equity firms, should be evaluating firms on. Firms like Lloyd's and Bill's stand shoulders above firms who kind of walk in the door with a pot of money, but quite frankly have never built their way out of a paper bag. And so it's important when you're making those decisions to partner with people who have demonstrated company building expertise. At Fairview, we're fortunate because a number of us were ourselves venture capitalists and or private equity professionals before getting into the fund of funds business, if you will. And it's one of the things that we know is critical to success and that we look for as we're evaluating teams. Do these guys know how to build companies?
So you're all three, folks of color. Your firms are primarily led and managed by people of color. Is there anything about the way you go about your business that's different because of your not your professional background, but your background in the society in terms of how you look at opportunities, how you manage investments once you're there?
Well, I will say from a management perspective that we probably operate and have since inception with a higher degree of paranoia and sense of lesser degrees of freedom to make mistakes than we might ordinarily. So, for example, we're in a regulated business. We're a registered investment advisor. We have been since day one. The SEC can put people like us out of business overnight. So compliance infrastructure and paying attention to things of that sort as we operate our business become critically important for us, because having, when they come in to do an evaluation, which they're prone to do and can do at will, and they do that periodically every 10 years or so, sometimes with a greater frequency, as they come in and they evaluate you and determine whether or not your shop is operating up to snuff. If they cite you with a number of significant or material deficiencies of any sort, those things do not speak well to institutional investors, and you can find yourself having even more difficulty than you might otherwise have raising capital. So I have to say that we probably do operate with a sense of, as I call it, lesser degrees of freedom or thinner margins for mistakes. We have seen people in this business. And the reality is, look, if you manage a private equity firm well over time, you've got a group of investors who are sophisticated, and you do well by them, the likelihood is that they're going to stay with you over time. Having said that, we have observed that it is sometimes the case that minority managers sometimes have greater difficulty keeping people with them through a minor hiccup that would perhaps go unnoticed or not something worth paying a whole lot of attention to than some of their contraries. So, it's the country we live in. We've all grown up in it. We know that sometimes the rules by which we operate are different. And so you wake up every day and you go out and you do what you have to do to be successful. So.
I'd echo those comments. I look at, even in my corporate career, I know that I was looked at differently than my counterparts. I knew that I was evaluated differently than my counterparts. So with that in mind, when we started our private equity company, we I think Larry used the word paranoia. We were paranoid about the fact that we would not necessarily get second chances. So we over controlled things, which was a good thing, because at the end of the day, these small companies, in some cases, they really didn't understand how to grow. They didn't understand how to get productivity and so on. So us working with them, teaching them those skills was a good thing. And it allowed us to be upfront and personal on where are we winking at performance. We don't want balance sheets misstated or anything like that. We don't get that second chance. So it was important that we stayed close to those portfolio companies, and we still do. And quite frankly, in some cases, the selling managers, while they wanted the money, they really didn't want the advice. And you had a problem that you had to solve for.
As I heard Larry and Lloyd answer that question, I heard my father's voice in my head drilling into me when I was a little kid and older, saying that you're a black man, and if you're going to succeed in America, you're going to have to not just be as good as everybody else, you're going to have to be better. You know, I think that's what all of us were taught, right? That we've just, as Larry described it, it's that narrower margin of error. And as Lloyd said, you don't get second chances. And, you know, that's, for those of us, you know, who grew up as African-American professionals, that's what we had to learn. That's what our parents instilled in us. And if we can instill that in our portfolio companies, they're going to perform better. And that's what I like to think we bring to our investments.
So we started to get a few questions in, and if you don't mind, I'll share some of them with the panel. Laura, we have one for you, someone who has a manufacturing experience base, was wondering how your team manages supply chain and vendor management risks related to cybersecurity and political sanctions.
Okay, I'm sorry, I was muted for a second. You know, the key thing that I learned growing up in manufacturing was you had to have a set of daily, weekly, monthly measures in order to you know, be successful. And typically, it should tie to the ledger. You know, so in most of our cases, we set up these measures, we call them KPIs, where we're looking at what's best in class, and then how do we chart your facility or your business towards those best in class metrics. You know, so it really is them micromanaging themselves. When you think about cash, well, you know, the reality is having inventory turns that only turn 2 times is not world class. You know, and a lot of our companies, when we get them, they're turning their inventories 2 to 3 times. Typically, we will get those inventory turns up to 8 to 10 times. You know, which says that we are managing their cash differently, and their free cash flow is going to be significantly improved as a result of it. Small companies don't know how to buy things effectively, you know, so, you know, it's managing, you know, generally, if you look at variable costs, 60% of the variable cost is in the material we use, you know, and by saying that you really don't have a process for how you negotiate and buy material, it says that you're not managing 60% of your costs. You know, so it's looking at every cost element, variable and base. The other is investing in these businesses, because what we found for organic growth, they don't have a front end that's really reliable. A lot of times it's the president of the company who has a few, I call them milk runs, and really good customers, but it's not growing a pipeline of customers and really touching every segment of the market that you could be enjoying some orders from. You know, so it's all of those things that make, you know, a good manufacturing business good. We also take our 14 companies and we get them together, and we put together those KPIs that we think are important and measure them against each other. And it's an interesting one. If you look it up, there's this matrix that I used in GE called the Trotter Matrix. And it was, to be really clear on it, it was a way I had fun and nobody else did. I mean, it was telling and getting, at the time, 200 manufacturing plants trying to improve to get to the best of the 200 plants that we were measuring them against. And it was a rhythm and rigor that we would do on a weekly, monthly, yearly basis on how they improved. So those same tools that I used in a GE corporate structure, we're using them in our portfolio company.
It was no accident that Jack Welch referred to Lloyd Trotter as his master of discipline.
I'm not surprised either. So Larry, from your perspective as a allocator of funds, and Lloyd and Bill, from your perspective as folks who have gotten this opportunity to do this business, and you both, by any external definition, are doing incredibly well. But from a macro perspective, we still have a sort of misallocation, in my opinion, between talented people who can manage capital and those who are actually doing it. So for our children and our grandchildren's sakes, how do we avoid having this same conversation 10 years from now, 15 years from now?
Well, look, I'll give kind of 2 cents, if you will, because I think it's dangerous to suggest that there has not been progress as a result of efforts that have been made over the last 25, 30, 40 years. People pushed and sacrificed to make change, and change occurred. I mean, as I look at this particular area, if you will, when Joanne and I started Fairview, our opportunity set, our realistic opportunity set, given the investment strategy of our first fund, was probably a pool of 20 to 25 teams of managers, period. And that was best case scenario. And you're trying to cull from that 20 to 25 a portfolio of best-in-class firms. It's incredibly difficult to do. Choosing 10 managers from a pool of 400 versus 10 from 25 and expecting that you're going to get best-in-class performance, they're different worlds. And the point of that is this: over that period of time, the number of young people who have gone to some of the best business schools in the country, who've gone off, who've had wonderful experiences in corporate America, in manufacturing environments, in tech environments, in entertainment environments, other environments, who have entrepreneurial energies and designs and ideas and talent up the wazoo, gone out and determined that they either wanted to become fund managers based on their experience or entrepreneurs based on their experience. The opportunity sets, the investable opportunity sets that folk like Lloyd and Bill and myself have today relative to what existed 30, 40 years ago really are night and day. So there's tremendous progress in that sense. And some of those people like us simply won't take no for an answer. They will push, they will do whatever they have to do to be successful, and they will be successful. So things get pushed forward as a result of that. Would one in an ideal world like to see things be made easier? Of course. Would you like for the playing field to become level tomorrow? Of course. Probably not going to happen, but it's going to get better. And it's going to get better because people will continue to push. You see it happening in the country today. We're at another node, if you will, right? People are raising the bar, raising the temperature. As a result of that, some change will happen. Will it get us all the way there? Unlikely. But will it push it forward? I don't think there's any question about it. And so in that sense, I'm incredibly hopeful. I think there are some conversations that won't need to be had, perhaps 25, 30 years from now, and that's good. But in the meantime, we still have to be, diligent about our young people going out in the street and facing dangers that perhaps are different for them than they are for others, and we have to prepare them for it.
So Lloyd and Bill, I've had a couple of questions come in that are very sort of opportunity focused in terms of your underwriting criteria, in terms of annual revenue, EBITDA, whether you look at structures, your investment horizon, those types of things. Could you, as we close, just give us a quick overview of those types of factors for your respective funds?
Sure. Well, again, we focus on the technology and communication sectors pretty exclusively. Mobility, broadband, some software services. In terms of types of companies, we're looking for companies that we're not a venture capital firm. We're looking for companies that have demonstrated that they can generate some some cash flow and ideally some leverageable cash flow, but not necessarily. We can write about $100 million equity check. That's a combination of what we'll write out of the fund and also with our co-investors. And I would say that most of our deals are more in the growth capital area. So we're investing in companies that are well positioned to grow in their sectors, but need additional capital to take them to the next level, are looking for partners like us who have a lot of experience in the sector and can help them, as we talked about earlier, kind of professionalize the business, bring in new management disciplines that will allow them to grow. In terms of holding period, we typically like to hold a company between 3 and 5 years. That may change if the company morphs with add-on acquisitions and becomes something much different or bigger than what we invested in, but that's sort of our general.
We're pretty much very much like the statements that were just made. Our holding period typically is 3 to 5 years. If we get lucky, it'll be shorter. But typically, there are two things that you're measured on by your investors: the IRR, and then your net return on invested capital. And the IRR, the longer you hold something, the worse that's going to get, because it's the time use of money kind of metric. So speed does count, when you're looking at these companies. When we look at a company, it's really based on what we know about the company and how we believe we can take it to the next level. It's not just about money. It is about how it's being operated, whether it's the sales channels, the manufacturing operations or service operations that we can improve. And then, like I said earlier, we love fragmented markets because we want to grow organically faster than the segment that they're in. And we want to grow inorganically as well by rolling up to a bigger company and doing acquisitions and getting the synergies and the integration to add to the bottom line. So it really is a repeatable process in our space, and that's where we live.
So one final question, and I want to just thank you in advance for this incredible discussion. And Larry, I know you have a lot of experience in this, but it also applies to Bill and Lloyd. Have you ever considered using the SBIC program at some point in terms of future funds?
We have not. We have not. When you look at our size, going the traditional routes, it seems to be the way we should do it. The SBIC program, there are some do's and don'ts that rules that wouldn't play well with our size either.
Yeah, the same. There are some constraints to that program would not be very attractive from our perspective.
And throughout our history, other than in the very early years, Peter, in the first fund where we might have invested on a private fund that sat alongside of an SBIC, or invested in a fund that did a drop down SBIC, that's just not something we've done, and haven't invested in anything close to it for 2 decades. So I think it's unlikely going forward. That's not to say that that vehicle might not be an appropriate one for some team of young managers to get on the playing field, who bring an appropriate set of experiences and whatnot, are able to raise a fairly small amount of private capital, and then can lever it 2 to 3 times with some SBA capital to establish a track record. But if you think about the broader industry, if you will, many of the most, certainly on the venture capital side, many of the most experienced, successful VC managers in the country today got their start running SBICs. And once the ERISA regs changed to allow them to go out and raise pension fund money, they were off and running. But they cut their teeth in that kind of program. And so, Menlo, Battery, there's just a bunch of them. That's where they started. NEA.
I didn't realize that. That's interesting history. I didn't know that.
Oh yeah. No, absolutely. Those guys ran SBICs from the late 50s, really to the late 70s. So when they ran out and raised their first pools of institutional capital in the private LP format, they, had in many cases 10 to 20 years of experience, running government money. Basically, that's where they cut their teeth.
Interesting.
Which is how my partner, quite frankly, knew many of them through that industry.
Joanne,
yeah, that's right. That's right. She served.
Yeah.
She was on there, even though she ran first the American Association of Mesbics and then NAIC. She also sat on the board of NASBIC, which was the governing body for all of those folk.
Right.
Right.
So Larry, Lloyd, Bill, thank you for participating today and sharing your wisdom and your knowledge. For all of the folks who are on the line, I've known these gentlemen a long time. In fact, we were joking about it before we started. Larry and Bill have known me long enough to have seen me when I had hair.
and vice versa.
It's been a while. So gentlemen, thank you for sharing your wisdom today, and thank you for taking the time, and Godspeed. Please stay safe, and we will continue our series, and it's going to be hard to top this one though. So thank you for all who attended, and again, this session has been recorded and it will be posted very shortly on our website.
Great.
Thank you, guys.
Thanks for inviting us.
Thank you, Peter. Privilege and a pleasure. Thank you.
Take care.
Bye.